Okay, the information from our cash budget is going to come from, start off at page 13, number 9. It tells us the company must maintain minimum cash of $5,000. They have an open line of credit. All borrowing they must do must be done at the beginning of a month. Any repayments they're going to be making have to be made at the end of the month. They must borrow in multiples of 1,000, and interest, they have to pay the interest when they pay back the principal, and the interest is 18%. So let's look at where all our numbers came from. First of all, our first number, our beginning cash balance, that is coming, if you look over on page 13, under cash, you'll see the debit of $26,000 from the balance sheet. It's coming right off of that. The cash receipts, we determined that is on page 13. Our cash receipts under part 1, I believe, or I'm sorry, page 14. Under part 1, it shows, for example, for January, our cash is $230. We add the two together to get our cash available. For our cash payments, those are the amounts we just determined. So our cash payments are going to come from starting off with inventory. If you look at the cash payments for inventory, it's $146,280 in January. Our schedule of cash payments for selling and administrative expenses are $87,000 for January. They tell us, again, back to page 13, they tell us that dividends in the amount of $30,000 were paid in January. So that's where that information is coming from. For February, beginning cash, oh, I'm sorry, we also have to remember we have to maintain $5,000. So if you took our cash available, $256, subtracted our cash payments of $263,280, you'd see we have a shortage of $72,280. They tell us we must borrow in increments of 1,000. So we need to borrow $13,000 in order to have an ending cash balance of at least $5,000. Okay. So we have an ending cash balance of $5,720. That will be our beginning cash balance for February. Cash receipts, again, from page 14. We show cash receipts in the amount of, for the month of February, in the amount of $247,500. We add the two together, we get $253,220. Looking for our cash payments, again, we have, if you look at the cash payments for inventory, it's $151,020 for inventory for the month of February. Operating expenses are $89,000. And then back again on page 13, they tell us we purchased land, cash for $8,000. So that, if you add all our payments, it's $248,020. We take our $253,220, subtract our $248,020, and we get a balance of $5,200. That's our ending balance. That's sufficient. We have to have $5,000, so that will be our beginning balance for March. Again, our cash receipts for the month of March were $268,750. If we add the two together, we get $273,950. Payments for inventory for March are $159,180. Operating expenses are $94,000. Purchase land for $2,000. So our total payments are $255,180. So here we have a surplus of $18,770. So we can go ahead and pay back that $13,000 borrowing. So we're going to subtract the $13,000 we're paying back. We also have to look at how much interest we're going to owe. We owe $13,000. Remember, we're paying it back at the end of a month. So we borrowed at the beginning of January. We're paying back at the end of March. So we're borrowing for 3 months. So it's going to be the $13,000. And we're going to have 3 divided by 12. And then the interest rate is 18%. So if you take 13,000 times 3 divided by 12 times 18%, you get the 585. We end up with a balance of 5185, and that's sufficient. We only need 5,000. For the quarter, when you look at the beginning cash balance, we start with the first month, the beginning quarter, 26,000. We add all our cash receipts together for $746,250. These two added together are $772,250. We add our various payments for inventory, operating expenses, land, and dividends. Add all those together for our total payments of $766,480, which gives us $57.70. We take our borrowing across that we borrowed back in January, $13,000, and our payments we made in March for $585 and $13,000. That gives us our $5,185 ending balance, which coincides with March. So let's move on to the income statement. Okay, now we're on the income statement. Our revenues, our sales revenues are $765,000. We got that from the total sales back on page 1. Cost of goods sold or cost of sales is 60% of revenues, so 60% of 765 is 459. We subtract the 459 from the 765 to get 306. Our operating expenses, we all determined that on the same page. So our operating expenses all appear in the schedule of cash payments for selling and administrative expenses. So it's $42,000 for salary and wages, advertising $75,000, shipping's $38,250. Our depreciation shows on page 13. It's part of number 4. It's $8,000. And then our other expenses are $114,750. So if we add these all together, we get $278. 306 minus the 278 gives us $28,000, which is our net operating income. We now have to subtract our interest expense, which we had just determined was $585. That gives us earnings before taxes of $27,415. So let's go ahead and we're going to have to do a couple things for the balance sheet, so let's just do it here because we have the room. So let's look at our property and equipment. If you look on the balance sheet on page 13, the beginning balance is 80. The purchase we have is land, so we're going to add our land, which totaled $10,000. And then we have to subtract depreciation, which is $8,000. So our total property, plant, and equipment is $82,000. For retained earnings, to figure out our retained earnings balance, we have to look at our beginning of year retained earnings, which is on page 13 on the balance sheet. So our beginning retained earnings were $95,400. We're going to add our net income, which is $27,415. And we're going to subtract our dividends. So we're adding our net income, subtracting our dividends. Our dividends are $30,000. So our ending retained earnings balance will be $92,815. So we need these numbers when we're creating our balance sheet. So let's move on to the balance sheet. Okay, so current assets. We just determined our cash, right? When we were determining our cash, our ending cash balance was $51.85. Accounts receivable come from part 1, $68,750. Our inventory, this is our desired ending inventory, comes from part 2, $93,600. We would add those together. $167,535 is our current assets. We had just determined our property and equipment. We figured that out. It was $82,000. So if we add these two together, we get $249,535. For our current liabilities, our accounts payable, we figured out in part 2, $111,720. Our capital stock, you'll find on page 13 on the balance sheet, $45,000. We have just figured out our retained earnings was $92,815. So if we add these two together, we get our total shareholders' equity of $137,815. We had the $111,720 and the $137,815 together, and that gives us our total liabilities and shareholders' equity is $249,535. So if you have any questions, contact me. I'm hoping we don't have to go over this at all in class, other than if we do meet on a Saturday to do the quizzes together. But hopefully you understand it. I think the rest of it was pretty clear. This might have just been the confusing part. So I'll see you in class.